Welcome to Be the Bank. Today's episode, we are talking 2023 non-performing loan sales results. We're going to show you all $6.5 million of unpaid principal balance that I sold last year so that you can start honing in your pricing to close more notes in 2024. So let's jump into it with today's agenda. Now, it's already episode number 64 and it's January 2024. Happy New Year to you. We're going to start with this month's recap to share some exciting updates on the FIXnotes website. Then we're talking next month's agenda, followed by those sales results, all of the deals I closed out last year, over $6.5 million of unpaid principal balance. Then talking about some market opportunities, as well as the Mastermind group, closing it off all with a case study as always. So first thing, excited to present the Mortgage Note Investing Forum. The place to talk mortgage notes with others online is FIXnotes.com/forum. It's totally free to get started. You can talk to others to learn things as a beginner or establish yourself as an expert if you know things and want to share with others. And then once you join the Mortgage Note Mastermind, you'll be unlocking a members only forum for more deeper content. So we've also got our members only call this month. We wrapped up on January 3rd. It's the first Wednesday of every month. And this one is available as all of them as a recording for members in our portal. This one was great. We heard from a case study, earning and learning with small balance first liens, one of our members. And then I presented the second session with the sales results of our most recent offering, the end of last year, as well as the complete behind the scenes process on all of the steps it takes to buy a deal, to have it service transferred to you, and then to start your onboarding and collection process. All right, so I just wanted to share this for the first time here, the client portfolio update, to show you what I'm working on with my clients on portfolio management. So actually, we just acquired over 200 loans for our biggest client here, 6.1 million of unpaid principal balance. These are non-performing loans acquired from a top 20 bank that I'm now working on the loss mitigation, the resolution process with those homeowners. There's 13 pending modification agreements already in the works and 7 completed mods and 1 full payoff already. So really excited with the progress so far on that, and all of the lessons that I learned there turn into case studies for this show and additional information for the Mortgage Note Mastermind members to hone their strategies and get better deals done. So at this point, the total assets under management, 422 first and second position liens. This is the portfolio that I'm actively managing for my clients, and that's over $15.5 million of unpaid principal balance currently on the books. So let's go on to the next month agenda. What are we doing in February? Well, to start off, we've got our members only call February 7th at 4, and that is the first Wednesday of every month. We're going to do new member introductions. We've got a great topic from one of our members on building a portfolio without raising capital. And I just added another presentation. It's not on the list here, but we're hearing from another investor's case studies on their first deal ever, how they resolved a non-performing loan when they first started, and their latest deal to see what has evolved over time, honing in their strategy and getting better over the course of their career in mortgage note investing. We're just now wrapping up our cherry pick NPL sales for our Mastermind members. These are closing in the end of February. All the bids are in now. That's $1 million of unpaid principal balance every other month that goes out to our Mortgage Note Mastermind members exclusively to our group from my non-performing loan sales clients. This latest portfolio was 54 loans, 1.7 million of unpaid principal balance secured by first and second position loans nationwide. So our next portfolio will be coming out in March, close in April. So join the Mortgage Note Mastermind group to be on the top of the list for these latest offerings. All right, so we do have new videos coming soon. I know you guys didn't see a lot of our Wednesday videos starting in January. We've got a new strategy, so hang on there. We'll have some more stuff for you soon as we hone in our content strategy for this new year. All right, so let's jump right into the market pricing for January. This is where I'm seeing pricing for both reperforming loans that are cash flowing as well as non-performing loans. So on the left side here, you'll see reperforming in green. These are priced based on yield. Since we know there's a monthly payment coming in, the pricing is really dictated by what an investor expects to return on their money. So for first position or senior liens, we're seeing pricing less than 12.5%, but normally down to sometimes lower than 9.4, but just about there is the range that we're expecting. Now, this means a 10% return, for example, if you invest 100 grand, you expect to get around $10,000 back per year. On the junior lien side, pricing is a little bit stronger with 12.2% all the way up to 18%. Now that 18% is a bit of an outlier. You're really only going to see yields that high when there's negative equity situations or a little bit more uncertainty in a deal. Most of the time, we're seeing junior liens trade for 13, 14% returns when we've got an ACH authorization in place with the borrower. So automatic monthly payments are coming in, and you do see some equity on those deals. So just as rule of thumb here, 12% return on a $100,000 loan, you're getting about $1,000 per month on your investment there. Now on the non-performing side, where we really focus, we price senior liens based on the fair market value, with a special consideration, of course, for the UPB, the unpaid principal balance, because you don't want to pay more than the borrowers owe. But on the fair market value of the home, there's a wide range here, all the way from 10% up to over 80% of the fair market value. And this is generally dictated by the value band. So lower value properties, $10,000, $20,000 homes or vacant land even, generally are priced on the lower end, 10, 20% of the fair market value. Whereas higher end properties, $200,000, $250,000 homes or greater, are normally priced on the greater end at 80% plus of the fair market value. But of course, don't pay more than the unpaid principal balance. So this is more of a factor for negative equity situations where the UPB is more than the fair market value of the home. On the junior lien side, we price based on the UPB, and generally between 14% on the low end all the way up to 72.5%. And that number has been coming down. As we'll see when we get into the nitty-gritty details on our sales results, you'll see that our peak pricing this year was in June, July, and pricing has been trending downwards since then. At this point, with the high end being in the 70s and the cheapest asset on the most recent offering we closed last year in December, we sold an asset for 14% of the UPB. Now, let's jump right into actually reviewing those 2023 sales results, starting just with a high-level overview. So we sold over 150 assets. There was 159 individual loans sold across 43, and I think it's actually 44 contracts. We'll see that in a minute here. These are non-performing first and second position loans secured by nationwide residential properties. Now, the total balance of all these assets was over $6.7 million. That's the unpaid principal balance, or UPB. And those contracts totaled $3.696 million. In other words, 54.8% of the unpaid principal balance. Our average trade was 3.7 assets at $86,000 per contract. The smallest contract we did this year was $1,400. The largest contract was $698,000. And within those deals, we actually had assets trade for less than $100 on some of those contracts. But that was all from 3 seller clients, and 22 separate buyers participated in these offerings. So let me start the Excel sheet here so we can actually take a look at the details. And I will dig in here to our portfolio level review first. So just so we can get oriented, over on this side, we see the number of assets, the type, non-performing seconds, first or first and seconds, the funding date, the principal balance, the amount they were sold for, and then the percentage of the UPB. So you can see that in January, we closed 4 deals, a total of $805,000, and that was $1.35 million of principal balance transacted with an average UPB here of 58.7%. As we go through the year here, you can see that we sell loans just about every other month. January, March, May, June, there was a straggler here. A bunch of deals in July. Let's look at this because this is where I saw the highest pricing of the year. We sold $900,000 of UPB for a total of $466,000. And actually, when you look at it this way, the cents on the dollar here wasn't anything huge, but you will see there's a couple outliers, 68.2%. And when we dig into the loan level, you'll see even higher pricing. And I guess actually this May deal was even stronger at 82%. That was a single non-performing second lien traded for 82 cents on the dollar. As we keep scrolling through here, we can see that near the end of the year here, we closed a number of deals in December, a total of $900,000 of principal balance transacted for $508,000, an average of 54.4%. So looking at it this way, we can kind of see that from 54.4% at the end of the year and 58.7%, there has been somewhat of a downward trend when you look at the aggregate here. And when we dig into the loan level detail, you'll see how some of these deals at 82% and some of the assets in these portfolios were pretty high pricing. So if we dig in now to the next chart here, I want to show you the state level overview. So you can see all of the states that we've transacted in this year. These are all of the subject collateral property addresses. And you can see that we've done business now in 26 states. You can see that our biggest states were Illinois, Florida, New Jersey with 15, Ohio with 15, and my home state, Pennsylvania. We had 24 assets transacted here. And I like looking at this chart because we can see the pricing as a percentage of UPB. And I want to turn on the filters here, but before we turn off these filters, let's just look at the high end and the low end here. So we can see that high end, that was 82%. And then going down through the list here, we did have some strong deals on the bookends here at the end of the year and the beginning of the year in the 60, almost 70%. But let's look down at the other end of the spectrum here with some 23.5% of UPB here, 24%. I mentioned the 14% of UPB trade. That one actually was a bit of a straggler. We've awarded that contract, but it's funding hopefully today, or at least before we turn over to the new month here. So looking at this, we can see that some pricing here has been, pretty consistently between those bookends of 23.5% all the way up to 82%, with this being an outlier, and these deals in the 20s being somewhat usual, and we'll see why when we look at the loan level details. All right, so now let's turn on the state level here so we can see exactly what we're talking about for state level pricing at the high end. We see California, 74%. This is pretty typical. California and Arizona have very strong note investing pricing. Arizona is a non-judicial state where foreclosures are very quick. Texas is as well, so I'm interested. Actually, we didn't do any Texas deals this year, so that makes sense. And I'm actually going to remove this so that we don't add that into our filter here. But we can see, looking at these metrics here, where our cheapest states are as well. So we've had the lowest percentage of UPB on our 10 assets in Florida. And this is really a factor of lower property values. We actually trade a good amount of vacant land notes in Florida. So these deals are much more affordable. And then looking up the list here, we can see Indiana and Kentucky are on the lower end here, but without much of a sample size. Ohio, with 15 assets traded, you can see that this is pretty firmly in the lower percentage of UPB states that we've got. Pennsylvania, not too much higher than that, 51%. And this is sort of the midpoint here between 53 and 56 with Connecticut, Michigan, Alabama, and Tennessee, but also pretty small sample sizes with these two. New Jersey, a little bit stronger, which is interesting considering that New Jersey is a judicial state where foreclosures do take a long time. But based on these property values being pretty strong in the New Jersey and New York area, you can see why percentage of UPB is pretty strong there. And now as we go up, we can see like Washington, D.C., also very strong property values there. You can expect higher pricing as a percentage of UPB because there's a lot of equity there. A lot of loans in Illinois, which I'm surprised actually is pretty strong, being a Rust Belt state with some difficult property situations, but overall like an average of almost 60% of UPB. And going all the way up back to California, where we did have 7 deals closed in California this year with the strongest pricing. So now let's look at the loan level here. And this is really interesting because we can see the breakdown. So I've sorted this by positive equity and negative equity, and then broken it down by first or second position loans. We actually had a couple of third liens here as well, which we'll look at. And then the senior lien status. So to start off, first liens with positive equity, trading for just 51% of the UPB. And the reason here, we talked about this on that initial page with the pricing, is because a lot of the first liens that we're looking at have lower fair market values. And when you're looking at home values that are averaging less than 100,000, the percentage of the fair market value where those are fairly traded is typically on the lower end, whereas the second liens we trade have much higher average property values. So you can see that the seconds with positive equity traded for substantially more at 59.4%. You can see our highest tier there, no surprise, current senior liens. Second position loans with equity behind current senior liens are the creme de la creme of second lien investing. These deals went for 62.7% on average here, and we did sell 91 high equity current senior seconds. That's a really great place to be looking for loans, but I always encourage investors to also expand their preferences because sometimes the big home runs are when you're spending 38 cents on the dollar for an unknown senior lien, or even less, 15 cents on the dollar for a negative equity semi-current second lien. So some of these trades can be much more lucrative, but it's nice to diversify your portfolio with some singles that are definitely going to be winners, as well as some long shots that could be home runs if you knock them out of the park. So scrolling down the list here, you can see how the pricing sort of trends downward, but then it is interesting to see these foreclosure initiated loans priced higher than the unknown. This is important to mention because when you reduce uncertainty as a seller, you can maximize the value. So in this case, with these foreclosure initiated loans, the second lien holder, because there's positive equity, can expect surplus funds at the sheriff sale. So the first lien is doing all the work, sending the foreclosure, having the attorneys work through the process, and then when it actually goes to the sheriff sale, because there's equity, the second lien holder is going to get paid. And in this case, they're priced almost at 50 cents on the dollar, because if you get a full payoff at the sheriff sale, you're doubling your money, buying them at 47 or close to 50% on the dollar. These third liens can kind of be considered like a second, as long as there's equity. In this case, they don't behave much differently than a second. So you can see the pricing here for semi-current at 50% and unknown at 41. And there was only a single asset of each of those, so very small sample size. As we move into negative equity, we can see 21% of the UPB was the pricing of the first liens with negative equity. You can see that's a big drop off right off the bat from 51 down to 21. And that is because first liens are priced based on property value. And because these ones are negative equity, there's a higher UPB, balance owed from the borrower, than the value of the home. So this balance, it doesn't really, they're not paying for the balance, they're paying for the property value in this case. Going on to negative equity seconds, we can see pricing at 41.3% of the UPB. And going down the list here, it's interesting to see that these two unknowns were actually higher priced than the current. And this could be because with an unknown senior lien, the equity is actually unknown as well. So it could be that the investors who purchased these unknown deals actually had a bit of an arbitrage here, getting some additional information that maybe wasn't available on the spreadsheet or the data tape, that they could determine that there actually was more equity than met the eye on first pass here. Now, as expected, the cheapest section here at 8.8% is a foreclosure initiated negative equity second. This one is a long shot. If it goes to sheriff's sale, you're probably going to get wiped out. And if you're able to get a deal done with the borrower, it's probably going to be a substantial discount to what they'd expect, since there is no equity in this deal. So for $2,000, that was worth the risk. And in this case, with the $23,000 potential upside here, it could be a decent deal if the borrower is able to reinstate the senior lien and they decide to stay in the property. Then finally, we got one third lien with the current senior that traded for 54 cents on the dollar. So this is kind of the across the board look at the loan level. Before we get into my compensation on these loan sales, which I want to share with you in a minute, let's look at the high level loan, the loan level granular view here of all of the assets in the portfolio. So if I drill in a little bit, let's see the cheapest deals and the most expensive. So on the high end, we have some pricing above par value. So these ones are huge because there was a payoff balance that was substantially more than the unpaid principal balance. So in this case, pricing was actually more than 100% because there was more than the UPB owed. On the low end, we can see that pricing of a few of these deals is in the pennies. This one was sold for $51. And you can see there's actually a good amount of loans that were priced very, very affordably. Even one with positive equity here, but with an unknown senior, that positive equity is actually just unknown equity. But that being said, these deals were packaged up with other assets. They weren't sold as one-offs for these prices. The cheapest one-off deal, as I mentioned, is a deal that's closing very soon here for $1,400. But otherwise, these are the very lowest end pricing, foreclosure initiated, unknowns, with very small fair market values as well. A $2,500 home here. This is the highest one with $121,000 fair market value, but with the unknown senior lien, it could be totally underwater. All right, finally, to wrap it up here, let's talk about the sales compensation, because part of what I teach in my course is how to create your own loan sale advisory. So a loan sale advisory is essentially a mortgage note matchmaking service where you find sellers that have assets, non-performing loans that they need to monetize, and then flip them to buyers who are looking for these types of opportunities. So within the Mortgage Note Mastermind, we have a Secrets to Sourcing course, which teaches you how to find these motivated sellers. And then being a part of the network allows you to have a built-in buyer's list of non-performing loan investors who are looking for deal flow. So in this case, I earned $176,000 this year. I earned 4.7% of the $3.7 million that I sold this year. And my pricing, my compensation here is a bit more than market because I do all of the negotiations and the marketing of these assets. I also do the transaction. I do the servicing transfer, as well as all of the assignments, the allonges, which transfer ownership of the note to the new buyer, as well as the contracts and all of the servicing transfer. So I'm essentially a full service loan sale advisor, whereas you can earn 1 to 3% just by making introductions. So this is all part of the course. As a Mortgage Note Mastermind member, you get these masterclass courses, which I think we should move on to talk about next here. So let me pull up the presentation and we'll jump into our assets for sale, as well as the Mortgage Note Mastermind overview. All right, so assets for sale, at this point, we are putting out at least 1 million of unpaid principal balance every other month to members of the Mortgage Note Mastermind. And this is our Podio workspace where we have the aggregated trade desk. This is a screenshot from a little while ago, so this isn't updated, but we just put out our most recent offering for January to close in February. Those bids are all in, and we're gonna have another trade coming out in March. This not only includes opportunities from me and my clients, other members transact assets on this portal as well. There's no fees to get deals done, to meet other buyers and sellers. And my assistant will also aggregate all the opportunities we see in the industry on this same sheet. So based on my 12 years of experience and network, I get tons of emails from sellers. We put these here to introduce you as a Mortgage Note Mastermind member to other sellers in the space. So as I mentioned, our January offering is out now. The bids are already in. It's 54 non-performing first and seconds. There's never any minimum trade sizes for our offerings, which is super important. It's one of the major barriers to entry in this business. Trying to get a deal done for like a $500,000 minimum investment when you haven't done your first deal doesn't make a lot of sense. So for our deals, we're closing assets for just a couple $1,000s. So you can build your system, you can build your processes, you can set your vendors up with a small balance loan to get started using the Mortgage Note Mastermind exclusive opportunities that we list here. All right, so the Mortgage Note Mastermind, I've been talking about it a lot. Just to give you the high level here of what's entailed, we do have asset purchase opportunities, the masterclass video courses, private events and Zoom calls, our vendor database, our forum, which you can go to for free now before you get access to the private members only forum. We've got case study details. All of the case studies that I present on this YouTube channel are organized in more detail, the type of exit, the type of asset, so that you can really dig in on specific deals that you're interested in learning more about. A county and state level database with all the laws and understanding what different jurisdictions require of you as a note investor. We've got templates and calculators. We've got Excel sheets and Word documents and mail merge and all the things that you need to get your business off the ground. And then of course, that trade desk is where we aggregate all of those asset purchase opportunities. And of course, as a member of this group, you get 50% off consulting with me or just free consulting by asking questions in our forum where everyone can chime in and build that collective knowledge together. So we do increase the price of this group by $10 for every 3 new members that join. So we align the value of the group with the network effect and the additional content that's constantly being added. So definitely lock in your price today. So let's just run over to the case study here and get things going here with our reperforming loan today in second position, secured by a single family residential property that was sold. Fitting that we're going to be talking about a loan sale today as we've went through all of those high level overview of deals we've done this year. So this loan was sold for $11,892. And if we look at the details here, the fair market value was $289,513. The senior lien was $216,645, leaving us with $72,000 of equity, securing our $21,000 balance. Remember, this is a reperforming loan. So if you bought this as a non-performer, got it cash flowing again, and then sold it, you could essentially do a fix and flip as a non-performing loan investor. So in this case, we're going to ask 3 questions of our deal. Was it a bulk or a retail sale? What were the findings in due diligence? And then what was the final purchase decision from the note investor? So this was a bulk sale, part of a year-end closeout a couple of years ago of legacy inventory. So this was actually a reperforming loan that was sold somewhat at a fire sale to raise some capital. So you'll be interested to see what kind of returns the investor was able to achieve on this one. So This was actually late 90 at acquisition. So when we bought this loan as a non-performing second, the senior lien was in default. So they were now getting back on track, but they were still rolling late fees about 30 to 60 days behind on their first position mortgage. They were owner occupied, so they were living in the subject property, and they're paying $283 per month for our lien. So we wrote a modification agreement on this account at 120 months at 8.75% interest rate. They paid a $250 modification fee at closing, but there was no down payment. We held the deal for 8 months, so we had some seasoning and some track record. Now, I will say if you get a down payment at a loan modification event, you can sell that loan a lot quicker without as much seasoning because the borrower has shown that they have some skin in the game and they put that down payment towards their modification. If they don't put a down payment, as we see here, letting it season for at least 6 months is necessary to get the best possible price for it on the secondary market. But in this case, we actually sold this loan. We bought it for, actually, I guess that first $11,000 was incorrect. We sold this loan for $67,000 as part of the package here. And it's because that, no, this doesn't make any sense. This doesn't make any sense. Sorry guys, I think the 67 was the full value of this package. But the considerations here that we can make are actually still gonna have value, even though I had some typos, so I apologize. But this was a seller fire sale. So they were recapitalizing so they could execute on some year-end opportunities. So these cash flowing loans were purchased as part of a diversified package. There were some non-performing loans in the portfolio as well as some cash flowing loans. So the pricing on the cash flowing loans was particularly attractive because this was about getting some funds for other opportunities. And that's something to look out for as a buyer. When you're working with sellers who need the capital for other opportunities, that is where you're going to get the best possible pricing because they may not want to sell, but they may have to sell because there's better opportunities for that seller elsewhere. So higher cash on cash return in this case was achieved due to the spotty senior lien status. So if the senior lien was current, we would have a much better chance of getting the highest price for this deal. But because the senior lien was rolling 30 to 60 days late, they were consistently making their payment a month late or getting caught up or being 2 months late. The pricing for this reperforming second was much greater yield. The buyer needed to get a better yield to compensate them for the uncertainty around that non-performing or spotty performance of the senior mortgage. So in this case, the non-performing loan investor actually did earn a 100% internal rate of return over those 8 months, purchasing the loan as a non-performer with a 90-day plus late senior, getting the borrower caught up with the junior lien and seeing that senior lien status go to 30 to 60-day rolling actually allowed us to more than double our money on that 8-month turnaround. When you look at internal rate of return, a very important factor is the time value of money. So doing this deal in 8 months as opposed to a full year gives us a much stronger internal rate of return. So in this case, we bought it for 21 cents on the dollar at acquisition because of that uncertainty. And when we sold the loan, we were able to earn that 100% internal rate of return. So in this case, it was sold for 54.5% of the UPB. So yeah, I guess that was my mistake here. The package was a $67,000 portfolio that was sold. This particular loan was sold for $11,892 or 54.5% of the UPB. Really good discount for a reperforming loan and a 26.5% cash on cash return. That is huge. That is breaking the scale that we talked about in the beginning of this call for the January 2024 pricing for reperforming loans. And the reason is this was a deal that was done several years ago and those opportunities come and go. So it's important to be ears to the ground, seeing these opportunities in the market so that you can jump on deals like this from motivated sellers. All right, so that wraps up our case study for today. And that pretty much does it for today's episode. So, of course, check out the FIXnotes website. We've got the FIXnotes Mortgage Note Forum where you can talk to other investors, get news as a beginner, or start sharing your own knowledge as an expert to establish yourself in the industry. We've got FIXnotes.com/MNM or just MortgageNoteMastermind.com for our private network, which eventually will be $990 per month. But right now it's only $280 per month. We actually only have one seat left at $280 before it goes up to $290 a month for the next 3 members. Now, I will mention this, there is an initiation fee for the mastermind group. So to join, you'll have a 90-day accelerator program before committing to the monthly rate. So that's an important thing to mention. And to get on a strategy call with me to talk more about that, you can go to go.fixnotes.com to book a time on my calendar to talk more about how the Mastermind group could fit for you. And then finally, Mastermind members do get 50% off consulting. So $250 an hour for me to be on a Zoom call with you, to look over your shoulder as you do due diligence or work on a portfolio resolution. I can help you with all of that. I've been doing it now 13 years as of this May. So I'd be happy to share all that knowledge, of course, for free here on YouTube and on the forum, and then in a private setting if you need more advanced information. All right, so mortgagenote.mastermind.com or fixnotes.com/MNM for more information about our group. And then for those of you who are already in the mastermind, go to podio.com/fixnotes/mastermind for everything that we offer in the portal. So that's it for today's episode. Thanks for joining us for, of course, the industry overview. We've got the tech tips, we've got the vendor reviews, we've got assets for sale, case studies, giveaways, and so much more on the FIXnotes YouTube channel. Thank you, everybody. Always a pleasure. I'll see you next time. You know where to find me in the comment section below. And sorry if I missed your live chat here. Please leave a comment and I'll get back to you as soon as I can as we wrap up here. And in the meantime, I'll wish you the much success for 2024 and looking forward to working together with all of you. All right, have a good one, everybody.